As I was standing up here, Khalid reminded me, or asked me again, how does it feel to be mic'd up like a rock star? And that is exactly the feeling I get every time I stand up and someone tapes a mic to the side of my face. It's great to be here. Khalid has kind of let the cat slip. I mean, confessions up front. I am an actuary. Apologies for that. We'll take the actuarial jokes later. I won't reference any of them directly. In kind of briefing me, I mean, literally what you just heard from Khadis is pretty much what he told me. He's like, hey Dave, come and talk. We want something different. And I said, but what do you want me to talk about? He's like, well, whatever's on your mind, how you think about the life business, a day in your life. So that's what you're going to get. I'm going to talk about exactly the kind of stuff that's going through my head and what I'm trying to do. And maybe by way of introduction, I mean, I've actually only been in this role, it's approaching 2 years now. But right up front, when I was appointed as the statutory actuary initially, I found this little slide template, and I particularly like this little guy, because that's pretty much exactly the way I was feeling. There's clearly a sense of adventure, looking to the future, and there's new stuff happening here. I suspect this is a first day at school, so that's a bit what it feels like for me as well. Right. So now, first up, I mean, to my mind, what's happened in risk management, a lot of the regulatory changes that you're seeing at the moment, is you're seeing stuff being regulated, you're seeing people kind of going through the motions of doing things that when I take a step back and look at them, they really should just be common sense. They really should just be the way we conduct business. But we typically go out of our way to create piles of reports and monitoring and governance and policies and quantification and stuff that often isn't terribly useful and isn't terribly relevant. So I go back to the kind of life lessons that all of us have learnt and live by. And one of the key things, I mean, particularly now having kids, is the importance of learning to take risks. I mean, it's something all of us have had to learn to do, and it's something that we actually do on a daily basis. So if I reflect on this morning, I mean, I kind of woke up relatively early. First call that kind of hits the little decision tree is, do I go for my run this morning or not? I mean, there's a lot of other stuff that I'm trying to get done. There's mails that I've got to get out. There's calls that I've got to make. There's things that I've got to do. But actually, long term, it's right. It's important that I go and get my exercise. So clear my head. Head out and go for a little run, jump in the car, shoot through into the office. I had some things to pick up. I had a pile of mails to fire off. I had a telecon I had to get onto, and then someone said, "Oh, Dave, by the way, you need to have that conversation with Jim, the chairman of the risk committee." I was like, "Dang, you're right. Okay, so now, but my next commitment is a meeting at the Financial Services Board at 9 o'clock." And I'm thinking, oh, I mean, I'm running a tight show already. I don't know what the traffic looks like. Let me set that call up with Jim. So I sit down, I type the mail, and of course it's one of those where, I mean, you can just smash up a mail and send it, but given who you're sending it to, this is probably a mail that you want to get right. So you kind of do a couple of deletes and one or two edits, and now the mail goes off, and quickly shout a couple of commands at my PA and dash out the office. And jump in the car, and I'm going fine. I'm cool. I'm cruising off to the FSB, and boom, there's an accident just after Rigel, and the highway is jammed. So now this is a meeting with the regulator, with our chief exec and our FD and me, and I'm never gonna get there. Okay, so GPS quickly routes me off onto the R21, scuttle through the back suburbs of Pretoria, and get to the meeting like 20 minutes late. Now, what happened there? I mean, I was making risk-reward trade-off calls. I mean, I had mails, I had stuff to do, I had things I needed to attend to, but I also had to get to the FSB. I mean, had I gone earlier, maybe some of those things I could have done anyway, but I was making trade-offs around the benefits of taking an extra 5 minutes, get this job done, move it forwards, versus the risk of getting to the FSB late. Okay, and this morning it blew up in my face, but we're doing that every day. I mean, as I'm driving there now, and I can see I'm going to be late, do I put the right foot down a little bit harder and break the speed limits? I mean, what are the consequences of that? Every day we jump in our cars and we're making those calls. We may not be kind of bringing them into our consciousness, but we're making those calls. We're doing this all the time. little risk-reward trade, and some of them are big, some of them are small, and they have different consequences, and we'll talk about that a little bit now. So, kind of, I mean, as you progress through your life, I mean, this is something that you learn. If I kind of reflect on my experience, down here is choosing a career. I mean, now again, I mean, this is a trade-off call. I've got to kind of think about the future. I mean, what are my relative earnings prospects? What's the stuff I'm good at? What's the stuff I enjoy? How long is it going to take me to get there? And I mean, then you end up studying this actuarial program, and you got part-time study to do after you've graduated. And again, I mean, the whole way along, there are little trade-off calls that you've got to make. I mean, do I go to the cricket today? I mean, I love cricket. I mean, that'd be great. But I've got a pile of stuff I've got to study. If I do the study, I've got a better chance of passing that exam. Still managed to fail a couple. If I go to the cricket, I mean, there's the benefits and the upside, and maybe a bit of sunburn along the way. So every day we're doing this. In my past, I've climbed a couple of mountains. I mean, so this one up here is Aconcagua, which is one of the 7 summits, highest mountain outside of the Himalayas, about 7,000 meters, just under. And when you go to places like that, it brings it home kind of up close and personal. You realize that what you're doing is risky. I mean, you're taking very obvious physical risks, but there are benefits as well, and you're making that trade-off call. So I firmly believe that the biggest risk one can take is not to take one. I think the same applies to decisions. The worst decisions are the ones that are made by default. So right underneath everything that we're doing in business, everything that I'm trying to do as a risk manager, I think is founded on these kind of life lessons. And what that process is about, all of us, the whole time, we're scanning our environment, we're trying to identify the risks, we're weighing them up, we're assessing them. And we're making calls around what we do and don't do, how fast do we drive, I mean, what kind of mitigants do we put in place? And I'll tell you some more of my stories in a moment. And then as that situation unfolds, how do we monitor it? Do we now change our mind? Do we shift course? Okay, and that's what risk management is about. But all of us are risk managers. Right, so then let's move on. I mean, certainly my life, some of the big decisions are around things like getting married. Now, who do you choose as your partner? I mean, that for me is a call that you want to get right. I mean, I'm not a huge fan of sort of, okay, well, that one didn't work, undo, I mean, let's try something else. So to my mind, this was a commitment, a long-term commitment, a lifelong commitment. And so as a result, to my now wife's frustration, we dated for like 9 years. So there you go. There's a bit of a lesson in risk aversion. And I guess there were benefits to that in that we got to know each other a little bit better. I mean, the downside was once or twice, I mean, she actually thought, well, maybe I need to go somewhere else because this ain't going to happen. And I mean, clearly then down the road, we end up having kids. And so just quickly to without belaboring the point, tell you some of the stories here. I mean, so now we'd been married for a while. I mean, things weren't happening the way we'd like. So eventually we go to the fertility doctor, and boom, when we arrive there, he does a scan and says, "Folks, you're pregnant." He just looks at us. I mean, that's how good he is. You're pregnant. Go home. Okay, cool. So now we go home. Now again, you're into intuitive risk management. So what do? We sign up for antenatal classes. I mean, you go and you hear all the lessons about natural birth and cesareans, and you read that fat book, What to Expect When You're Expecting, and you do all the science, and you prepare yourself, and you've got your birthing plan, and then life happens. And for our first child, I mean, the whole plan was natural birth. So I was really keen on a natural delivery. But right at the death, she just got spooked and said, "No, let's go in and have a cesarean." And so you have one of those surreal experiences where you kind of book yourself into this hotel, and you go home with a baby. I mean, that's sort of what it feels like, at least for the boy. It's probably a little bit different for the girl. And just again, I mean, the calls there around natural Caesar. I mean, that's a great risk-reward trade-off type decision with different kind of benefits on each side and different downside costs. So that's the arrival of this little guy over here, Tim. then kind of things progress. We want a larger family, so sort of a couple of ectopic pregnancies and one or two other adventures along the way. Pregnant again, and this time Zoe is adamant, natural birth. Now, natural birth after Caesar is a risky thing. Doesn't happen all that often. Lots of gynaes discourage it, not going to support you. Our gynae was very clear, happy to do that, no problem. She's assessed the risks, but here are the terms and conditions. And she had very strict requirements that we needed to meet. So we had to be in hospitals, I had to be catheterized, couldn't go more than 10 days post-date, couldn't be induced, various bits and bobs. And off we go. That's the plan. And of course, then we get to it. Now I don't know, it was 10 days late and things hadn't quite happened yet. And so Zoe lobbied and negotiated for another day or two. And eventually she goes into labor. Now again, our plan was stay at home as long as possible. And if you're in hospital and you've got these nurses all over you and they're monitoring contractions and all of that good stuff, so stay at home. So we stay at home, and around about midnight, so he's like, okay, Dave, time to go. I'd been sitting there reading What to Expect When You're Expecting because I'd forgotten from like 4 years before. And shoot into hospital, get there, and Zoe's like, this is sore. Let's get that epidural going. And they have a look and they say, no, sorry, you're not dilated enough. No epidural for you. So I was like, really? Goodness, maybe this natural birth thing wasn't such a good idea after all. And then all of a sudden, 45 minutes later, boom, baby's arrived. Literally, our gynae kind of ran into the delivery room, and as she was stepping in, out comes Kev. So that's Kevy, this little guy over here. Then we take the brave decision, have another, and this time around it's a girl. Now, that introduces a whole lot of extra dynamics into the mix. Now I'm thinking long-term, the size shotgun I need to buy, all of this kind of stuff. Again, we had such an awesome experience with Kevy, the natural birth. Zoe's adamant, wanted another natural. But what we hadn't factored into our thinking is that now this is a third child. And so your body works a little bit differently. And without going into all of the details of the story, this one we ended up having at home without any medical folks present. So it was a bit of a clipsy. And I guess the thing is, all the way along, you're making these calls, okay? You're scanning the environment, you're assessing, you're needing to come up with a plan and manage through, and that for me is the key lesson out of it. Importantly as well, you learn pretty quickly that actions have consequences. So it's not like these things just happened to us. We were actually doing something to make them happen, and it's the same in business. Every day, the decisions we make have consequences. Right? Okay. And then we had a big oopsie, okay? So we were now a happy family. We'd made the call, kind of no more kids, have the snip, and boom, next thing, another child arrives. Okay, so there we go. That's the mob. We're now pretty damn certain we're not going to have any more. Okay, so we've closed out that risk. Right. Okay. So I guess my point there is this is about life. It's about the stuff we all know. It's about risk-reward trade-off decisions. It's about decisions and actions have consequences, and that's what my role is about, is just making sure that people are doing that on a more conscious basis than the kind of natural intuitive process. Right, okay, so let's talk a little bit about life insurance. And Gladys, you'll have to wave at me if I'm getting carried away and going over time. Okay, so life insurance. Now, for me, a lot of folks kind of try and grapple with the life insurance industry, and it feels different, it looks different, it behaves differently. And why is that? And the accounting's like all weird. You've got different standards that just apply to life insurers and don't really apply, or maybe short-term insurers as well, and don't really apply anywhere else. And I've spent time trying to unpack that. Is it really different, or why is it different? And the only thing I can come up with is that it's a pretty unusual business in that what we sell is promises. Literally our business is about customers giving us their money, often in large quantities. They're giving us their whole retirement savings. They might give us all of the wealth that they've accumulated through the accumulation phase of their life, buy an annuity with us, and we give them a piece of paper. And that paper contains a promise around mean, under what conditions are we going to pay a claim? Or when are we going to, under what conditions are we going to return their money to them with investment growth and an underlying guarantee? Excuse me. And that's unusual. I mean, there are not a lot of industries that are like that. I mean, there's kind of very little tangible transfer, and then the type of promises that you're talking about have unusual characteristics. So, in particular, they are long-term promises. They 20, 30, 40, 50-year promises that we're making. And there are not a lot of businesses that do that. I mean, I can't really think of any others that do it, certainly on the scale that we do it. And maybe just to kind of head down that tree of the long-term consequences. As a result, the small little changes now. I mean, something shifting. You've heard this thing around when you're going on a. I mean, if you change your course by just 1 or 2 degrees, 100 meters down the road, you're in pretty much the same place. But 1,000 miles down the road, you're in a completely different place. And that's because the promises we make are long-term. Very small shifts in the here and now have massive, big, long-term consequences in terms of where you eventually end up. So that's this point up at the top about the butterfly effect. The butterfly waving its wings somewhere in China, causing a hurricane in the Gulf. Okay, so long term, as a result, what's really important, if we want to ensure that we can deliver to our customers, that we've got sufficient money set aside to meet those promises, we need to hold liabilities, reserves. I mean, I always get all mixed up between what the accountants want to call these things, whether they're provisions or reserves or liabilities. I mean, let's not worry. We need a pile of money to discharge our policyholder liabilities. Okay, and not only that, but things might turn out differently to the way we're currently expecting them to turn out, be it policyholder behavior, mortality rates, interest rates, inflation rates, any of those parameters that are important to actually assess what is the value of the promise that we've sold could turn out different to our expectation. As a result, we need to hold a whole lot of capital. So we need to stress the base case and hold financial capital to support the risk that we're taking on. And again, we're doing that to ensure that we can deliver to customers under a variety of scenarios and circumstances. Okay, so that's all cool. But what it introduces is great debates around liability measurement. How do you actually assess the value of the promise that you've made? What's the right way to do that? And I guess actuaries have been doing this in various different ways around the world for a couple of 100 years. So it's not surprising that it's taken the accountants about 20 years to come up with an accounting standard to try and actually pin that down. But I think we're pretty close to one now. And importantly as well, I mean, that's why you find a whole lot of actuaries in the life insurance industry. Because what actuaries are trained in is they're trained, I mean, at a fundamental level in statistics, which is all about uncertainty, and financial maths, which is all about being able to take problems, turn them into cash, and move those cash flows through time. And when you're talking long-term promises, that's really important. So you find them in pensions industry and the likes as well, which have the same characteristics or similar characteristics. And we'll talk in a moment about liability measurement, the inconsistencies in the local markets, and the multiple bases that we currently measure things on, and to my mind, the risk that introduces. Okay, I mean, then heading off down this bottom leg of the tree, not only are these promises long-term in nature, but they are customized, they're bespoke. So we sell contracts to individuals, and the terms of the promise that we make are contained in the policy document to that individual. And as a result, I mean, how the charges work, the kind of guarantees, either on the investment value, on the premiums, when we can review things, exactly when we pay claims. I mean, all of that is quite different. The definitions under which certain benefits pay. Excuse me. And not only that, but the terms are locked in, which means that you take away your flexibility. You take away your ability to actually roll with the punches. I mean, and change the terms post-fact, or I don't know, close a fund down and move people into a different fund. So that's important from a risk management perspective, that what we're dealing with is things that, I mean, in our case, for example, Liberty's got about a 50-year history. We've still got contracts on the books that were written in the 1960s. In a different world. I mean, when the world worked differently, financial markets worked differently, you didn't have the depth and liquidity that you've got today. And so some of the things that you look at now look pretty odd, pretty strange. But we're bound to those contractual terms. In addition to that, importantly, what this does is it creates, in most instances, very complex legacy. So a range of products. I mean, in our case, literally hundreds of different products written by a number of different companies over different time periods, different structures, different philosophies, different markets that they were trying to target. And that makes life hard, because now you've got this proliferation of systems, processes, products, portfolios, metrics to measure things that you've got to manage through. And you've got a management team here now in place that have inherited a legacy from the last 30, 40, 50 years. And obviously that drives costs. It causes complications in terms of delivery of MI from a consistency perspective, just an extraction perspective, and similarly on the data front. Okay, then the brief foray into matters liability measurement related. Why am I as a risk manager interested in liability measurement? And fundamentally, because if I want to quantify any risk, I need to be quantifying it against something. I mean, it kind of sounds obvious, but I mean, if we take a simplistic example, if we're interested in our profitability, which most businesses are, you can now frame a risk metric. Okay, so profitability on a published basis, an IFRS basis. I can now frame a risk metric that tells me what is the risk to that profitability. So in this case, the example I put up here is IFRS earnings at risk. If I take changes in the world, interest rates, equity markets, persistency and the likes, and those things move off my expectation, what does that do to my expected profits on a forward-looking basis? Now I can start sorting these risks. I can get an idea of which are the big ones, which are the small ones, and I can start putting numbers to risks, which is important. I mean, to not only engage a technical community, but to make a whole lot of decisions. If you want to start getting into return on capital metrics and the likes, you have to go there. Okay, so I've got a basis that describes how I measure assets and liabilities. That spits out an earnings number, and I've now framed a risk metric against that. I mean, not going to go into all the detail of the confidence level that you might look to assess this at. It's probably another whole discussion of its own. But our challenge as an industry is that there are many of these bases, and they're not the same. They behave differently. So we've got the IFRS basis, published reporting. Maybe skip over here. I mean, for a long time, the South African insurance industry has reported what are referred to as embedded value numbers, which are trying to represent kind of shareholder value of the in-force book. And as a result, any conservatism contained in or prudence, let's use the right word, contained in the published basis, effectively we're saying, well, what is that worth? If we know that our liabilities are actually overstated relative to our best estimate, which they're required to be in terms of the regulations, then there must be value locked away in those liabilities. And again, for EV, I mean, here I can get my EV earnings, and up at the top I can say, well, what is my risk to a change in EV? So each of my profitability metrics, my balance sheet metrics, I can frame a risk metric against. But the problem is, if I'm doing this in the published world, in the EV world, in our case at the moment in the statutory world, which again is different to IFRS and EV, going forwards in the SAM world, economic basis is kind of an internal view of what my assets and liabilities actually are. This makes for a lot of complexity. And these things, as I say, they might behave differently with respect to, for example, movements in interest rates. And so to the extent that we can get convergence and consistency of measurement bases, it's really, really important. And it's one of the things that worries me, because I think this introduces a lot of risk into the life insurance industry, where folks are actually just confused around what is the thing that they should be measuring or managing to. Because, I mean, for example, if you're trying to set up market risk management capability, you need to point it at something. You need to say, manage my market risk with respect to IFRS earnings, or manage my market risk such that I minimize my economic capital requirements. And once you've done that, it's going to have other consequences on other bases where things behave differently. And I mean, it's a constant battle to, work through all of that and understand, okay, we've hedged out the risk here, but it's popping up over there because of something that we did that was framed in a particular measurement basis and made complete sense, but is now giving rise to unintended consequences elsewhere. Okay, and so IFRS 4 Phase 2, it's taken a long time. I think where it's landing is actually reasonably sensible. I think it's going to be a huge implementation for the life insurance industry, and it's going to result in a lot of change in actuarial areas and in finance areas in life codes. But I'm actually quite hopeful that it's going to simplify the challenge I'm up against, because and I'm probably using all the wrong terms, but the kind of base liability I think is broadly sensible. I mean, it requires best estimate assumptions. It's largely market consistent. Okay, I mean, there are one or two little differences in terms of how overhead expenses and the likes get treated, and maybe we'll have tussles about fascinating things like units of account. But in the main, I think we're going to end up somewhere sensible. Things like risk margins, we'll have a bit of discretion to do something sensible. So there we can look to align. And sorry, all of those things I've said are closely aligned to where the SAM basis is going. On the risk margins, SAM includes a risk margin. It's prescriptive. And it kind of works. So if we end up heading that way, I think that's a great thing if we get those base liabilities. And then obviously on top, you'll have this contractual service margin, if I've got the terminology right. That will behave a little bit differently, but that's okay. I think we can manage that. I think we'll have enough commonality and convergence underneath to actually simplify our lives. And not only that, but that'll then bring the published basis and what the future stat basis, as I say, at a core level closer together. And I'm hoping we can drive a bit of convergence of the embedded value basis to something aligned to that as well. And of course, the tax man is headed down the IFRS route as well. I haven't got him up on slide. Okay, so that's liability measurement. Then I thought, I should give you a flavour of the kind of stuff that I'm thinking about, and the things. I hesitate to say they keep me awake at night, but they do get me up earlier. And in a nutshell, they relate to change. So firstly, you've got this massively developing market. Customers are behaving differently. They're demanding different things. They are changing the products. Where previously they might have been perfectly happy with some kind of retirement annuity solution, now they're looking to move on to something new. There's a new proposition in the market. I want to take my money and I want to move it elsewhere. And that straight away means, firstly, you've got to be developing your propositions. You've got to be putting a new product to market on an annual basis. Every time you do that, there's risk. Not only in the implementation of the product, but you've got to get a sales force trained up to actually provide sensible advice on this new proposition. You've got all the issues around cannibalization of your existing business. Are you going to have people switching out of what they've already bought into something new? What's that going to do to your long-term expectations around that in-force book? Focus on conduct and TCF. I'm sure many of you will be aware of the kind of challenges we're up against in terms of exit charges on historic products, regulators coming many years post-fact and challenging practices. Quite prominently in the UK recently, the FSA pretty publicly put out some views on how they felt legacy book operators had been conducting themselves, and they've got them on a bit of a short leash. So there's a lot that we can talk about here. Those are certainly very, very big in my mind. Changing advisor behavior is another massive thing, and particularly when you layer in some of the conduct changes that the regulators are looking to introduce through the retail distribution review, where it's going to be a complete overhaul of advisory practices, how these folks get remunerated. That's probably going to change the number of advisors that are in the game. And I mean, for those advisors, it's going to be seismic. I mean, what they do every day is going to be completely different in many instances to what they did previously. Big impacts on their revenue streams. And obviously, I mean, at the moment, we're living in a world where our advisors are remunerated mainly on commission. That itself introduces a whole lot of risks around the conflict, agency principle type challenges. Okay, then on the regulatory front, we've spoken quite a lot about it already, but I mean, there is just a wall of change. I mean, pretty much kind of every piece of what we touch is being rewritten in a way. I mean, so you got this massive FSR bill, the Twin Peaks bill, that's looking to kind of set the frame from a policy perspective for the whole of the I mean, not only financial services, but broader, I mean, financial system, and introduce very clear prudential authority and conduct authority. And that's really big. I mean, that's, I guess, why it's taking some time. There's reform of the retirement funding system, so retirement fund reform. We touched on RDR. SAM obviously is giving effect to the insurance prudential rules that the Prudential Authority will look to have in place. And importantly, not only that, not only are the rules and the regulators themselves changing, I mean, they're changing to be less rules-based and more principles-based. And it's much easier to operate in a rules-based environment. You kind of know what the rule is, you can ask yourself, and you've got much more black and white. Once you're in a principles-based world, you need to be challenging yourself the whole time in terms of whether what you're doing is actually okay and what it's going to look like post-fact as market practice develops, as time moves on. You're not going to be able to say, well, I mean, the rule said no more commission than X, and I haven't paid more commission than that. Now the regulator is saying, well, you've got to ensure that you're conducting yourself appropriately. So you think about, I mean, whether or not paying commission at all is appropriate. I'm not going to tell you. We'll talk post-fact. In addition to that, the policy statements out of National Treasury have been quite explicit in terms of the increased intensity and intrusion from supervisors. And I mean, certainly we are seeing that on pretty much a monthly basis. We get an information request that might look innocuous at first glance, but when you look at it from multiple different perspectives, consider where the discussion might be going. I mean, these things have potentially significant consequences. So there's new conduct returns. There's been a whole discussion of exit charges, expense basis reviews, and. I mean, it's a bunch of really big topics. Then you got the compliance challenges around the rules as they are today. To my mind, outside of the banks, I think players in the financial services sector are in for a wake-up call from a FIC and an AML perspective. The SARB has been, again, 100% crystal clear. I mean, they've actually said, guys, outside of the banks, we believe you all have room to get to where we need you to be. So whether you're talking asset managers, short-term insurers, life insurers, watch the space. And then importantly, I mean, all of the stuff, the classic response to regulatory change is we need to comply. And the problem with that is that these are shifts in the landscape. It's, I mean, and big fundamental shifts. I mean, they might happen fairly slowly over time, but once you add them all up, it's a completely different environment you're actually operating in. And so responding not only, I mean, you have to comply, clearly, but getting into the mode of actually firstly looking at them as needing a strategic response. Is there a business line that I exit? Does this open up an opportunity given, I don't know, the bank's changes in capital and liquidity requirements, and so now life cos can play a different role to the one they played in the past. Similarly, down at a business level, are there product lines that I need to reconsider? I mean, we've just had a massive change in tax rules with the introduction of the fifth tax fund. That means repricing a whole lot of product lines. It means electing options in respect to the in-force book. And responding at all of those levels is is a big challenge. And I mean, I'm obviously talking about prudential and conduct stuff, but I mean, if you just think about the amount of regulatory change that's happening, be it in the employment space, tax, I mean, it's a lot of stuff to think about and respond on a strategic basis. Then, I mean, in the background, we've got, certainly in this country, very unstable socio-political environments. We just come through elections now. We're busy with what I hope won't become Gordon Gate. But I mean, it's just news flow that has huge ripples into financial markets, for example. And I mean, not only there, I mean, rates and equities and all the rest moving around, but customers, I mean, also make choices. So if we reflect on what happened post Neni in December, I mean, a whole lot of people said, okay, I need to get money out. And the consequence for us is they surrender their policies. They take their money and they go and, I don't know, they go buy a house in Australia or put in a bank account somewhere earning 0% interest. And not only that, but from a people perspective, I mean, certainly my take is it just puts strain on everybody. Everybody in South Africa is kind of looking at this and asking themselves, am I doing the right thing? I mean, actually sticking around, or should I be going to Australia or the UK? I mean, we've certainly lost a couple of people doing exactly that. Then you've got from back to kind of pure risk perspective, I mean, all the physical security risks. I mean, this kind of instability. You have the EFF galvanize the march, and they're going to go march to the JSE. And now, I mean, suddenly there, I don't know how many folks it was, but 40, 50,000 red beret and t-shirted blokes heading past your front door. That can introduce some stress into the system and give you one or two things to think about. You got ISIS out there. I mean, just kind of open season around the planet. I mean, if you get a good idea to create some noise and attract some attention, do it. And if, like us, you own some big super regional shopping centers, I mean, those make great targets. So there's a bit of stuff that I think about there. Back to the people thing and this socio-political environment. Given the complexity in our environments, again, my experience is that you'll find there is heightened key man risk. There are certain systems where there is only one person that actually still knows how that thing that was built in the 1980s operates. And there are only one or two people that know how this particular with-profit fund declares its bonuses. And you can try and write stuff down, and you can try and change those processes, but I think, given the complexity, the legacy, you're always going to have heightened key man risk. And if one of those key men happens to be the person that decides to go to Sydney, you've got a problem. So we're ending up with some interesting employment arrangements. We've got people on contract living in Melbourne and the likes. And then, of course, I mean, internal change. You're changing operating models. You're changing people's roles, moving them around the shop. Given that environment, it obviously introduces risk. Quick notes on Africa. Most of the big life cos in South Africa have some sort of aspirations outside of South Africa. Straight away, this introduces another whole world of regulatory change. Most of these African regulators have got big ideas about risk-based capital requirements and I mean, changing tax rules and all the rest. And complying with that lot can be a challenge, and we've seen a good number of nice big public accidents with MTN up in Nigeria. Standard Bank have had their challenges in Nigeria as well. And you run into the debates that happen between group saying this is how we do stuff, and the guys in country saying, well, we're in business, and here it works differently. So whatever your group standard is, that's cool. Keep it in Joburg, and we'll crack on and do our thing. And then, I mean, if you're going to expand, you're typically going to make acquisitions, big risks. Every time you make an acquisition, you can do a DD, but it's never foolproof. You're always going to typically find that it's a little more messy than you thought when you were looking at it from the outside. But you got to do what you can. Okay, economic outlook, I won't talk about too much. The market volatility, I think we've touched on. maybe just to emphasize, I mean, the balance sheets that we run are complex because you've got this combination of, I mean, if you think about a bank, you've got all of the kind of operational complexity of dealing with retail customers on the liability side of the balance sheet, where I've got millions of little individual accounts with bespoke promises that I've got to keep a track on and have my call centers and deal with my customers and all the complaints. But the nature of the promises that those give rise to are much more like the kind of hairy things you'll find in an exotics desk inside a bank global markets environment. So management of the balance sheet is complex, complex risk exposures, and you need to make sure you got the capabilities required to deal with that. So you end up with complex hedging programs, all the derivatives and the likes, liquidity issues that arise. That said, there are also opportunities, and particularly with some of the changes to the banking environment for life insurers to play slightly different roles, and so most of us have reasonable sized credit books and are looking to extract liquidity related opportunities. Through all of this, metrics and MI for me are a big challenge because you've got this plethora of systems and products, and actually just knowing how many customers, what is the sum assured exposure, what is my profitability per book, is a difficult challenge to crack. I mean, you can obviously do it at a high level, but if you want to get down to the nitty gritty, it's tough. There's cost pressure. As a result, folks are, for example, looking at outsourcing. That introduces another whole set of risks, another whole bunch of stuff for us to think about relating, for example, to the crowd across the road in Maitland. Cyber security, okay, won't go into that one, but I mean, again, there have been a number of big public examples, and I mean, very definitely a threat for all of us. Many of these things can end up having an impact on your reputation, and in funny kind of ways. I mean, so I chuckled. I mean, Liberty recently exited a healthcare admin in South Africa, and Liberty Medical Scheme merged with Bonitas. But the way the headline came out, I don't know if you guys heard it the other day, the Competition Commission approved the merger of these two medical schemes. And what the headline was, Competition Commission approves takeover of Liberty by Bonitas. And that's not quite what's happening, but quite difficult to undo now. And through all of that, and there's tons more that I could talk about and I could put up, is my role, and what I try to do, what I try to spend time thinking about, is how do we get focused on the right stuff. There's lots of things that we can worry about. There's lots of stuff that can go wrong. But what are the right things for us to be focusing on? So, for example, when we go into our board risk committee, I mean, what I'm trying to do is actually, if I could script the meeting, what are the things I'd want us to spend time discussing? And having discussed these things, what's the outcome I'd like to have? And once I've got that in my mind, now I can make sure that the reporting is actually getting me to a point where I'm going to do that. But I mean, the problem here is you can just get lost in all of this stuff. You can report hundreds and hundreds of risks. It's not terribly useful to anyone. I mean, telling you about all the stuff that might happen doesn't help. But if I can point you at the 5 or 6 things that we've got to all be aware of, on top of, and comfortable that we're managing right, and then live with the fact that some other stuff, and even those, I mean, might not go the way we'd intended. So in order to do that, I mean, at least what we're doing is getting risk people as close as possible to the point of decision making. So I talk about a deployed risk model. If risk people are coming post-fact, once a call's been made, they're useless. There's no point. I mean, the best you can do is you can report on stuff. And then it's not in our world, we talk about tell functions. You set rules and oversee their implementation. Then the risk function becomes a tell-on function, which is what my kids do at their age. So thinking through how we get the right risk people close enough to the big decisions managing the big risks arising out of those changes that we're driving is important. Obviously, governance is a critical part of that, because I mean it's a big part of what governance structures they're about. So that's kind of in a nutshell is the stuff or a selection of the stuff that's going on and that I'm thinking about and sifting through, and then trying to get down to what are the key things that we need to have on the table and we need to make sure we're addressing. Okay, so, I mean, bringing it back, and I don't know how I've done for time. Am I on track? I'm okay, 5 minutes, cool, good, so we're going to land. So what is it that I love about this job? I mean, it's amazingly diverse. I mean, as you can see, and as I say, I mean, that's just a small selection. There's a lot of things to think about. A lot of balls to juggle, I guess, as you'll find in the role of a chief exec or an FD. Lots of things to weigh up. It's intellectually challenging. I mean, so it's not. I mean, it's not just all those things. But now you want to get into risk quantification and actually practically getting to the point of driving into business decision-making considerations of return on risk-adjusted capital. I mean, that's a complex problem to crack, and not only in terms of the technical details, but in terms of the kind of people problems that you'll come up against and the politics of organizations and how to actually navigate and get things done. Importantly, I mean, if you go back to that previous slide with all the bubbles, all of those things are actually interacting with each other all the time. So you got something happening in I don't know, physical security space where there's a bomb threat on one of our properties that has a knock-on into the reputational environment, which now gets a whole lot of negative news out there about Sandton City, for example. And next thing, customers decide they don't want to be invested in Sandton City because they see risks to returns going forwards, because maybe some terrorist threat's going to come off and foot traffic's going to die and our rentals are going to drop off, and so they're not going to generate good returns. So understanding, I mean, and look, it's a hell of a difficult to actually think through all of those kind of things in advance, but understanding that they are all connected and they do all play off against each other is important to be able to work through and raise in your awareness. I mean, then I kind of said it, but I mean, this isn't a compliance role at all. It's a strategic role. It's a business role. I sit on the group exco. I'm part of all the big decisions. And critically, my success in the role is dependent on my ability to influence outcomes, as opposed to win technical debates, kind of irrelevant. So, I mean, I've put up the vision for our risk function, and the only piece I'd look to pick out, I mean, obviously there's sustainability in there, there's pieces about managing inside a risk appetite, but importantly, I mean, we see ourselves as actually, enabling value-creating risk-taking, because we understand that business is about risk. It is about taking risk. It is about doing stuff. And every time you do that, or even if you don't do stuff, you are taking risk. So you have to take risk if you're in business, if you're alive, and so it's about enabling sensible, profitable risk-taking. So I'm by no means the business prevention officer, and I guess, I mean, around the world, there's kind of an evolution of what's happening in risk functions, from kind of classic business prevention, the guy's going to say no every now and again, to the guy who sets the rules and oversees their implementation, through a wave of quantification, maybe advisory type practices. And now where risk functions are going, and certainly where I'm looking to position our risk function, is as integral to those business decision-making processes, as present in the decision-making, wearing a particular hat, and in some instances actually developing components of the strategy and driving it. And so as a result, some of the hard lines that have been drawn between first line, second line, third line are starting to come down. And you still need people playing the roles, but you don't need to kind of take a bunch of folks and put a sticker on their head and say, right, you can't be part of decision-making, because actually they've got value to add. So right, I mean, that's kind of all I had to talk about. But I mean, I'm happy to engage and take questions. I certainly get a lot of questions from these guys. So let's chat. Stunned silence, yeah.
David,
In our case, they are.
I understand that, but you see that it's not the case in all life companies.
Yeah.
Why is Liberty opted for that group?
So, I mean, look, it's a debate that I think is playing out across the industry, and different folks have gone about it in different ways. There's very definitely a close connection between the role that the chief risk officer plays, and that, I mean, let's call him the head of actuarial control, because I think the statutory actuary is something embedded in the current Long-Term Insurance Act that we're going to retire with the LTIA. So the risk officer and the head of actuarial control are going to need to work closely together. They're providing assurance around slightly different things, but they need to be connected. And then I think it's down to how you organize them. So in our case, I mean, the thinking is that risk is the kind of broad overview category head, but you need someone specifically watching how you set assumptions, how you set policyholder liabilities, and whether or not you've actually got your capital quantification right. And that those are the primary roles that the head of actuarial control will fulfill, assurance around those things. I mean, obviously he's also got a role to play in terms of reinsurance programs and asset liability management and the likes. But I mean, certainly when I was appointed as statutory actuary, I mean, again, I spent some time trying to understand what is this role about. I mean, why would somebody have written this thing into the Long-Term Insurance Act? And the answer I got to was that that fundamentally it was around delivery to customers. I mean, so you've made a promise. First thing you need to do, make sure I've set aside sufficient money to meet the promise that I've made to the customer. Secondly, if something goes different to what is expected, do I have enough to discharge my promise in those circumstances? So now I need to hold capital. Thirdly, I need to take an interest in how we manage asset liability management risks, because those are the big things that can prevent me from discharging my promise. And then you get into things like reinsurance programs and underwriting policy and all of the other components of the statutory actuary's role. And when you work through it, I mean, those are actually all about risk management. So I mean, I think it's hard to have the two functions too far apart. And I mean, I think Sanlam's in a situation similar to ours, where the chief risk officer and the actuary are kind of together in the same person. I think Mutual, I mean, they've got different people playing the roles, but I think the actuary reports into the CRO. MMI is, so they've split, but I mean, at least for a while, Colin was reporting to Jan. I don't know if he still is. And that's our situation. So what I'm busy doing is actually extracting myself from the actuarial role, and Dion, as head of actuarial control, will take that on, but he'll still be in my reporting structure as a piece of the risk management system. Cool.
Any further questions, Andre?
David, if you think of board notice 158, all the requirements that's in there,
Yeah.
from reinsurance to market conduct and all the policies and stuff like that. So, are you involved in all of those committees? How do you get the information so that you can make a...
So I can make my assessment. So the way we've set ourselves up, I mean, I've got a team of call them, I mean, largely specialists. So arranged primarily along the lines of risk types. So I've got a head of operational risk, head of insurance risk and quantification, someone who looks after financial market risks, that's credit, market, liquidity. I've got an enterprise risk manager, and then I've got folks looking at effectively the regulatory landscape, and finally conduct. So I've got risk type heads, and basically, I mean, what we've tried to do is drive the decisions into key governance forums, committee structures, and then I've tried to make sure that I've got the right people deployed to those structures. So we're very explicit that in order to make decisions, you have to have a representation of risk people. Preferably, you need like 50% of the vote actually needs to sit with risk folks. Sometimes, as a result, I mean, you'll find that people outside of the core business, I mean, I'll put in the risk camp, So sometimes, for example, the FD plays a risk type role, looking at things from a group perspective. And I mean, that is back to what I'm talking about when you talk about deployment. So trying to get to a place where the key decisions are actually being exposed at those key committees, and I've got the right representation there. I'm not sure I've cracked it, because I mean, you do end up with a load of places that you could be present. I mean, I've still got a bit of work to do to not try and be everywhere, and make sure I've got the right people at the right places. But it's a challenge, because at the end of the day, the board and the regulator, I mean, they're not going to take it as an excuse. Oh, I didn't have time to look at the underwriting policy. So, I mean, clearly I can't look at all of it myself. I mean, but it's about having someone that I've got confidence in, and I'm comfortable they are applying their mind in the right kind of way to give me the assurance that I need to be able to do that for the regulator and the board. And I mean, just on that, I mean, kind of building. I don't know how many of you have looked at the Marburg report on investigation into Able. It's actually a really good read. It's quite compact, quite entertaining too, and I mean, certainly Marburg's read of the chief risk officer in Able was that he was probably the wrong person for the job. Didn't have the necessary kind of business understanding, and explicit comment made to say you can't have a chief risk officer who is sort of the leader of a bunch of people doing the risk management. I mean, the person actually needs to know enough to be able to apply the mind themselves. So I mean, it's worth a read to try and explore that sort of question. But it's a challenge. It's a big challenge. And I mean, maybe final comments. I mean, one of our directors said to me that sometimes you actually just have to sit across the table from someone, look them in the eye, and make a call around whether or not they're doing the right thing. And I think there's a lot that applies to. And I mean, you guys will know, any of you doing audits and the likes, that sometimes that is just what you have to do. So yeah.